My name is Brian Hextell. I work for Prudent Man Advisors, as Peter mentioned, known really to our clients as PMA. I've been with the firm now for about 18 years. Started off in the credit research area. I've been a portfolio manager now for 6 years, working with many organizations like the folks in the room as well as with FIT itself. I'm just going to provide a brief overview of who PMA is and then switch gears and talk a little bit about the economy and the market as it stands today. Really happy to be here today. First off, great presentation by Shane. I was taking some notes there on the financials because had a great meeting with the board this morning. We're going to be working with FIT to help work on some financial planning as well as an investment policy. And really that speaks to what Shane was talking about. This is a growing organization. The reserves and surplus are at a point now where it makes sense, and the interest rate market, frankly, is at a point where it makes sense to start thinking about other ways to invest the money. And in the end, the more interest income that's earned, that's going to be a benefit to everybody by reducing premium. So we're definitely excited to be a part of that. So PMA, we've been in business for over 30 years. We operate out of 11 states. We have well over 2,000 clients, and we're responsible for over $20 billion of public assets. And as a company focused on investing for entities that serve the public, we see ourselves as risk managers. This philosophy has definitely been helpful to us to add value for many, public entities, insurance cooperatives. This concept of being risk managers, being prudent investors, has again really served us well and helped us to grow over the past 30 years. Focusing in, the prior slide mentioned that there's actually 3 related PMA companies. Prudent Man Advisors, the company that I spend most of my time working for, is one of those, and we are a registered investment advisor. We're responsible for $6 billion out of that $20 billion in assets. We really have a fiduciary duty to serve each one of our clients' needs. And we definitely put together customized investment plans that are going to meet the needs of that unique client. So unlike a big bank that might be also focused on some corporate clients, on trust, on high net worth, I think our focus on this market really helps align our goals and objectives with our clients. So I already kind of mentioned our philosophy, but it's a disciplined investment philosophy. We're risk managers. We want to build diversified portfolios and add value for our clients. So don't want to bore you with a whole lot of PMA. I know everybody really likes talking about the economy just about as much as they like talking about insurance. So I'm going to spend the rest of my time talking about that. So big picture, thinking about gross domestic product around in the United States, we're continuing to trend at a level of growth that is below, I think, where everyone would like to be. I mean, the recession now in 2008 and 9, is more and more becoming a piece of distant past. But I don't think for most people it really feels that way. It still feels like we're almost kind of bogged down in that. And I think that really, this chart really speaks to that. It's that with 1.6% growth, that's like half of the growth rate that we saw prior to the financial crisis. So we've just not gotten the economy back on the same strong footing that it had been previously and that we were all used to. There's been a few good quarters. The second quarter of this year actually was a particularly strong quarter. The most recent estimate of GDP that came out was 3.1%. We did see increased business investment here these past 2 quarters. That's a big plus. The consumer is 2/3 of the economy, so it's always about the consumer in the U.S. But business growth is very important as well, and seeing a little spark of energy out of businesses is definitely a plus. We definitely don't think, though, that 3% growth number we saw in the second quarter is sustainable. It was kind of, things tend to fluctuate. Again, you can see some of the other quarters where we've seen that pop up. It tends to reverse itself, and we see this kind of 2%-ish trend continuing. The dotted line in green at the bottom shows the forecast on quarterly growth And you can see it's trending, right around that 2% level. Certainly hurricanes are on everybody's mind this year, in this state, of course, and in Texas and in other parts of the Caribbean as well. Certainly short term, we think there'll be some negative impacts in the markets that I just mentioned. But, it's a tiny silver lining, I suppose. But generally over the long term, you actually see an economic boost as a result of this sort of thing. I mean, people have to rebuild. Obviously very difficult, but in the long run, it has some advantages. So one of the first pieces in the economy that we've seen come out is that auto sales are way up. Why is that? Well, it's because a lot of people lost their cars in Houston with Hurricane Harvey. But that's one example of where that plays into the growth. So I wouldn't be too concerned that the hurricane seasons that we've experienced are going to have a real large negative impact on the national economy. But different nuances to think about. So these two charts speak to the employment picture as well as inflation. And those are the Fed's two primary things that they're looking at when they think about whether they want to raise interest rates or decrease rates. The Fed mandate is around employment, maintaining maximum employment while keeping inflation low enough. So the labor market is really quite strong. 4.3%, I think, 4.4% unemployment is the most recent number. Been on a steady decline down on the green line. Labor participation is definitely low. Some of that's big demographic trends like the baby boomers retiring. But we think there was also a lot of people who exited the employment pool during the recession. Slowly we're seeing some of that pick back up. So the Fed looks at the labor market and says, we're in good shape. That half of our mandate is looking good. When you look at the inflation picture, kind of aligned with GDP, it's really not where the Fed wants it to be. They want to see inflation trending right around 2%. That's indicative of healthy growth for the economy normally. That's a little bit low. So it kind of creates this conundrum for the Fed. Do we raise rates, don't we? And what we've seen so far is a very slow increase in rates as they're being cautious on that very point. The market is really facing the same conundrum. If you look at the stock market, maybe a personal investment portfolio, it's been moving up steadily. The stock market is doing well. It's definitely aligned with consumer confidence that's also been steadily moving up. Certainly around the election, there was a lot of hope around policy impact being a benefit. We've really not seen much of any of that in the past year. Pretty much no legislative of the things that were on the docket have come through. There is some recent hope around tax policy that could provide a boost to the economy, but numbers aside, the stock market does what it does. It's forward looking, and you can see it's been very positive. The bond market, not so positive. It's really a very flat yield curve. So the difference between short-term rates and long-term rates is not that big. That's an indication of two things, really. The long-term rate's really an indication of long-term inflation expectations and growth. So when you see long-term rates low, that suggests that bond investors don't see a lot of high growth in our future, kind of the opposite of what the stock market's telling us. And that flat and flattening yield curve is also generally not seen as a positive sign for the economy either. So, painting two real different pictures depending on who you want to believe. The Fed certainly looks to the market, but they're very much so data-driven. Janet Yellen will tell you that at the end of pretty much every press conference, is that all decisions are data-driven and it could change. But one of the most recent pieces of information coming out of the Fed is they're looking to wind down their quantitative easing program. Some of you might remember this program dating back to the financial crisis. It was intended to stimulate growth, keep interest rates lower, and ultimately push investors into taking more risk in investing their money and invest not just in stocks and bonds, but real investments in their businesses. Hard to say how impactful that was. Lots of academic studies around it, but the bottom line is that the Fed grew its balance sheet a whole lot. That made people certainly very nervous at the time, and the Fed still thinking about that as well, and they think it's now time to start reducing their balance sheet. So as those investments that they had purchased mature, they're going to no longer be reinvesting those assets. So that'll start slowly reducing their balance sheet. So the Fed has been a big buyer in the market. So simple supply-demand metrics, if there's less buying, you would think that would have some downward impact on price. When bond prices go down, yields go up. So, supply and demand tells us maybe we start seeing long-term rates moving up a little bit. The flip side of that coin, though, is that just like when they introduced quantitative easing, that was intended to stimulate the economy. Well, winding it down, that's kind of the Fed tapping the brakes. So just like increasing interest rates or unwinding QE, the impact could be slowing growth. So you have these kind of offsetting forces. I think our guess is that we're like weathermen, kind of. It's really just educated guesses, but our best guess is that there will be some upward impact on rates. So as people who earn money on savings, short-term investing, we want to see interest rates moving up. This has not been a market that's beneficial to savers, and we think that there'll be some positive impact here out of this. But again, I don't think it's going to make anybody rich anytime soon. Long-term rates in the 2% range is just still very low by historic standards. And really just wrapping it up with one more slide, and certainly going to have a little bit of time for questions, I think. But as I talk about short-term investors, what the Fed does has a big impact on market rates. This is a very busy chart, but let me try to break it down a little bit. Maybe I'll actually use my pointer. Oh, not going to hit that button again. But the yellow dots here each indicate individual Fed members. This is the end of 2017, 18, 19. The green line indicates the average of those yellow dots estimates. So each Fed member on a quarterly basis actually comes out and says, here's where I think rates are going to be. They don't name who's who, but they show up as these yellow dots on the famous dot plot. So the green bar is the average, and the white and purple are two different indicators of where the market sees rates at. So what we can see here is that this year, everybody's pretty well lining up thinking the Fed's going to increase rates one more time in December. And in 2018, the Fed's saying 3 more rate increases, and in 2019, 2 more increases. The market is saying maybe 1 more rate increase this year, 1 more, possibly 1 more next year, and maybe 1 more in 2019. So that's a big difference, and it all comes back to the same conundrum that I spoke about earlier. Is what is the real growth picture? Are we concerned about it? About tightening labor markets and the possible impact that could have on wage growth and ultimately inflation, or are we stuck in a slow growth economy and inflation is not a concern? Well, the market and the Fed have differing views on this. We probably land as a firm somewhere in the middle. Totally agree. 1 more rate increase this year in December, most likely. We think 1 to 2 more rate increases next year, so that kind of puts us, kind of towards the market. Probably not thinking the 3 that the Fed's saying, and we're not smart enough to guess what's going to happen in 2019. But so that's kind of our impression in terms of where rates are headed. And again, good for savers. Certainly tax policy, if that comes through, that'll have some impact. I think, given what we've seen here so far this year, it's hard to be real optimistic that any big changes come out of Washington here that have a real big positive impact on the economy. But, if that were to come to fruition, then, like Janet Yellen, I reserve the right to say we're data dependent and our opinion changes. So with that, is there any questions on the economy or the markets that I could answer? Yes.
You mentioned a possible change in Fed's investment strategy over some period of time. What would you anticipate that would look like, and then how will it impact the members?
Absolutely. And I don't want to give too much. We're just beginning conversations around this. So it's really important that we start with best understanding the goals and the objectives of FIT. We're going to start by looking at some of the cash flows to understand the cash position throughout the year. We're also going to sit down and talk with the actuary to get a better understanding. Shane provided some great data on where reserves and surpluses are at, but we want to understand that better. As far as the second half of your question in terms of the impact, the more revenues, and mostly premium is revenue, but interest income is another source of revenue, that can offset costs. So there is a potential positive impact for members on their premiums. Any other questions? All right, well, thank you for having me.